But it's certainly technology and shares of Yahoo that are moving higher this morning, not the rest of technology, just Yahoo, up as much as 3%. The operator of the world's most visited internet site reported profits that were a little changed from a year ago, but revenues were up almost 50%. The company's chief financial officer is Susan Decker, and she's joining us live from Mountain View, California this morning. Susan, thank you for being on the show with us again. We appreciate you coming back.
Thank you. It's my pleasure to be here. Thanks for having me.
Talk to us about some of the trends that you're seeing in terms of demand and prices for ad on your websites.
Overall, we couldn't have been more pleased with the quarter. If you look at the sources of strength, they were very balanced across both of our marketing services businesses and our fees-based business, and they were very balanced geographically. And as well, our margins held up very nicely, actually increased a bit year over year, so our cash flow was up close to 48%. And then down to the earnings line, if you took out the non-recurring gains in both years, we did 15 cents versus 9 cents, so actually up 77%.
Are you pretty much sold out for advertising on your home page in the fourth quarter? What does that look like so far?
You know, one of the great things about the web is that consumers create more and more inventory by using our site. So if you saw the recent numbers, we now touch 411 million people a month come to our site, which is astonishing. It's 40% of all the people who come to the web in general. And they create inventory. So we're seeing nice growth in a lot of our various sites, and that creates more inventory to sell. So we don't really face a lot of sellout issues in any parts of the inventory because we have ways with consumers making the total number of page views grow.
What kind of advertising did you see the most strength in? I mean, was it a particular ads that were linked to the search results? Was it the banner ads?
It was really across the board. You know, our total marketing numbers were up around 40%. That continues the growth we saw in the first half, which was up just over 40%. And even in 2004 and 2003, we grew 40%. So the fact that we're growing at that pace on a much larger base is really surprised us, actually. And we're seeing it really across the board, both brand and sponsored search, and in fact feel that the fact that we offer both of those services is a really interesting form of synergy because we're seeing more and more overlap between the clients of both. We mentioned on the call that 50 of our top search advertisers are also in our top 200 on the brand side.
Susan, David Dreeman, do you think the growth rates in advertising that you have now, which are spectacular, will continue for the next few years?
You know, I wouldn't want to get into forecasting the next few years for us or for the industry. I would just say that the industry as a whole is $22 billion this year, is estimated to be on a global basis, which is a pretty big sandbox. It's still, though, only about 4 or 5% of the $500 billion that's spent globally. So when you think about the fact that consumers spend 15% of their media time on the web, but the web is still only taking 4 or 5% of the total dollars, it feels like there's more opportunity for that gap to close. And when you look at the forecasters out there and a variety of different ones, most are projecting that the $22 billion industry becomes a $40 billion business in the next 3 or 4 years. And it kind of makes sense as well when you look at other forms of advertising, whether it's network television or direct marketing or a number of different newspapers are in that $40 to $50 billion range. And as long as the web can reach a similar amount of time and numbers of people, it stands to reason that it will capture more share of advertising.
And how much of that do you think Yahoo is going to capture? I mean, you painted a very strong picture for the industry overall, the gap that you expect to narrow. You must have some projections or some ideas about what Yahoo's stake will be in all of this big pie.
Yeah, we couldn't be more pleased. We've gone from about a 6-7% share a few years ago to close to 14%, we think, this year. We think we'll gain market share again of a very rapidly growing industry. So what makes us optimistic about our positioning is that we're very strong on the brand side and we're very strong in search, and the complementarity between those two businesses should position us well with advertisers.
We had one analyst yesterday who was saying that, that yes, you are generating a lot of money from your websites, but you could actually be generating even more. Would you agree with that?
We would. I think he's probably talking about the monetization side. We really have focused on the consumer side of the house in terms of growing our market share and maintaining it on a global basis in search. And the next priority is to try to drive the revenue per search up. We have a number of initiatives underway this year. We provided a little more clarity on those yesterday on our analyst call. But the bottom line is that we expect them to be launched later this year and throughout next year. And over time, we would expect to see very significant upside from improving our monetization.
What aspects of your search engines do you think can improve in order to try and overtake Google?
You know, our primary place we think we can improve is on the monetization side that we just talked about. We feel like we're really holding our own algorithmically, and ultimately that's the most important priority, because if people keep coming to the site to find what they're looking for, there will be any number of opportunities to monetize those searches. In terms of the monetization side, we have some upside from increasing our click-through rates and our coverage, and those are some of the specific targets of some of the initiatives underway right now.
The other initiatives that we've seen more from Yahoo is that you're developing really more of your own content. Is that a trend that you want to continue? When does the investment in the content start to generate enough revenue really to pay for itself?
You know, one of the really interesting parts of our business and of the web in general is it's a global platform that allows consumers to publish online. So when you think about our various verticals, whether they're search or mail or IM, or some of the media properties where we have blogs and Flickr where people are putting up their own photos, a lot of our content, the overwhelming majority, is coming from consumers, and it is not an expensive, it doesn't cost us money. It's really more we're providing the platform for others to find, use, share, and expand their insights. So yes, we're using some traditional content too, but in the mix of this, it's not a very important overall cost driver, and we actually see ourselves as a fantastic partner for some of the traditional content players that are looking for a big audience, because we do offer that to them if they want to distribute their content through us.
AOL.
Yes.
What do you think? There's been a lot of talk, of course, about the interest in AOL. How serious is it?
I really couldn't comment on that. I think that it does, when you look at AOL as a property, it had a great brand, but it is tied to an ISP network, which is declining in terms of narrowband, and so it makes sense what they're doing to open it up, and I would imagine it makes sense strategically to look at what they can do because they're the fourth player in the market.
All right. On that note, we ran out of time, but we thank you very much for rejoining us again today, Susan.
Thank you very much. Thanks for having me.
Our thanks to Susan Decker.